Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Diane King Hall. Let's get you up to speed on the market action right now as we see investors sort of keeping their eyes on what's about to play out here in Washington. President Biden preparing to meet with top congressional leaders, both sides trying to reach a deal and raising the debt ceiling. A lot of that leading to mixed market reaction right now with the Dow down about 234 points. We are seeing the S&P 500 down as well. Two key hearings that we're watching on Capitol Hill. We're going to have everything you need to know from the hearing on artificial intelligence, plus the Senate hearing on the banking crisis coming up later this hour. Our very own Jen Schomburger is going to be sitting down with Senator Elizabeth Warren. You certainly want to continue to watch that. But first, Diane, as we watch the markets today, we are seeing a bit of a split picture here in terms of how investors are watching all of this today. We've seen the bond yields pushing higher on the back of what is about to play out here on the debt ceiling. Investors looking for any kind of clues on that resolution. But really, the big focus of the day is some of those disappointing retail numbers.
Right. Well, there's a lot of focus today on a multitude of things. So it's taking some of the shine out of the market in terms of the blue chip stocks. The consumer is one of the things that started the day. One of the focus on Wall Street. Retail sales rising 0.4% in April from the previous month. That's according to the Commerce Department, but that was weaker than expected. The report coming on the heels of disappointing results and guidance from Home Depot. Joining us now to discuss is Jim Schmigel, SEI Chief Investment Officer. So let's get right into this data that we had on the consumer. What does it say to you, or what should it signal about market sentiment, Jim?
Sure. Hi, Diane. Thanks for having me. I mean, it's just another canary in the coal mine, if you will. The market is really trying to gauge what are the probabilities of recession, how close are we to recession this year, given the massive Fed action over the last 18 months or so. And the consumer has really been a bright spot for a long period of time. Flush with cash. Is that kind of running out? Is that kind of catalyst for propping up kind of the economic activity here? Has that reached its peak, and are we facing tougher times ahead?
Yeah, and to that point, we did hear from Home Depot today, Jim, sort of saying that consumers are starting to delay some of their projects. Discretionary spending is starting to pull back. If the current quarter or the results that we just saw from the last quarter, if that's not necessarily sort of a warning sign, what are we likely to see moving forward here because of the outlook that was given by the company?
Yeah, I think it's one of many. I mean, if we want to take a step back and kind of look at the macro picture here, this is really that kind of bottom up viewpoint of the individual consumer slowing things down. We've had three to four bank failures. We've had a systematically important bank in Europe go under. There's a lot of things that we're kind of adding to the list here that are giving investors this pause and this warning, and whether or not the Fed is done hiking or not done hiking. The market is still expecting cuts in 2023, which we think is a little perhaps off the beaten path of actual reality, given what Fed talking heads have been saying. So again, this is just the consumer part of this is just yet another thing to add to the list, that wall of worry, if you will, that we're headed for tougher economic times.
I like that term, wallet wary. All right, let's switch gears a little bit and talk about this debt ceiling, the debt dilemma around it. There's a lot of political brinksmanship just happening, and we've been here before, Jim. I mean, you go back to 2011, and it just comes down to the wire. What's your expectations with regard to what we're facing now? Do you expect a resolution?
We do expect a resolution, and I say that with a bit of hesitancy, because you're right. We have been here before. We've always made it out of this kind of political theater. Although there are some things about this time around that appear to be a bit different, and there are other things that actually are a bit of a silver lining. So we have a budget. That's a positive. That's actually a bit ahead of schedule. We can look at that and say, okay, well, now at least we have two sides that can negotiate from the positions that they have actually put on the table. The other thing, and this gets a little political, but I think it is worth noting, the popularity of the president is not in a good place. It has been falling. It's been falling relatively recently as well. Everyone is motivated to get something done here. Everyone is motivated to save a bit of face. So I think that the common view of the debt ceiling debacle that we go through every few years or so is that there's going to be volatility. We're going to wait up until the last moment, and we're going to get something done. I have to say we're kind of consensus on this. I think we do get things done. I think we do wait as long as humanly possible, but there's just no benefit for anyone involved in these negotiations to have one of the several bad outcomes come to fruition here.
But so President Biden has a trip coming up. So do you foresee this being one of those instances where they're just going to kick the can down the road to September, for instance?
100%. I mean, essentially, the entire debt ceiling itself is one long exercise in kicking the can down the road. I mean, the debt ceiling historically has done nothing because all the debt ceiling does is get raised time after time after time. And there's, the underlying issue here are the untouchables, right? There are the entitlement programs. If we really need to get a hold of government debt, which of course we do, if those are the third rail and we can't touch those and discuss reform in commonsensical ways that everyone can agree on, like raising the age or means testing or things along those lines, then honestly, we aren't really serious about solving the issue of government debt. So yes, this is just going to be another exercise of kicking the can down the road.
So, Jim, the expectation may be that we're not necessarily going to default on our debt, but you've had a number of executives, especially from the banking sector, have come out and said just to get up to that X date is concern enough that could already hurt the credibility. If you look at the market reaction, there seems to be an expectation that things are going to be fine in the end. Is there a bit of complacency?
There is a bit of complacency, but I will say in some areas, I mean, we do see differences in the yields of short-term treasuries, prior to the X date or what we assume to be the X date and those yields after the X date. Again, we've been down this road before. We're kind of conditioned to how this usually plays out, which is lots and lots of volatility right up until a resolution. But to your underlying point, absolutely, this is not helpful to anyone. To market participants, to investors, to politicians. There's really no one benefiting from this because this has yet to actually spur real reform in terms of government spending and being able to actually stay within our means. So yeah, I just don't see any upside whatsoever at all. And playing chicken with short-term yield and having to rely on kind of government accounting of being able to move things around to pay our bills. There's really no one that's benefiting from this. All this is adding is risk and volatility. And we just don't see any kind of meaningful outcome here other than let's just extend the date.
All right, Jim, let's switch gears a little bit and talk about the Fed. So their next meeting in June. At their last meeting, of course, they raised rates. Now, we've got some Fed speak out today. Cleveland Fed President Loretta Mester saying this, quote, when we get the policy to that rate, I think we're going to be holding for a while in order to make sure that the interest rate is coming back down. So I don't put it in terms of a pause. I put it in terms of a hold, end quote. And so let's just talk about that with the perspective of there had been some chatter around expectations for a Fed pause, possibly at the next meeting in June. I think that chatter has kind of died down a little bit given some of the recent economic data that we've seen. What are your expectations for the Fed throughout the rest of the year?
I mean, this is a really key point for investors to understand, and this has kind of been going on for a while now. It's been this debate over, do we get a pause or do we actually get a pivot to rate cuts? I think the recent talking heads outside of the one that you just mentioned have been a little bit more hawkish. They've been looking at this as being very, very data dependent, meaning depending on what we see coming in between now and the next meeting, which is not that far away, this could be a live meeting and we could see another 25 basis point hike. From our perspective, we don't think that's the case. We do think they skip a meeting. They did a lot of work in a very, very short period of time. Your graph that was on previously is a great graph. That is a vertical line going straight up in a 12-month to 18-month time frame. They did quite a bit of work, kind of unprecedented in the number of hikes in the short period of time. It is definitely worth their while to take a step back. There is a lag. We know there's a lag to monetary policy, and just to see how this plays out over time. They have a difficult situation that they're in. We have the lowest unemployment since 1969. We still have core inflation that has a 5 handle on it. This is not the time that they're going to immediately just kind of pause and announce to investors that they're completely done. They're going to be data dependent because their 2 mandates, price stability and full employment, they are at extremes even today.
So that points to more uncertainty. In that environment, where do you put your money?
We put our money kind of against what the market is pricing in, which is, again, a quicker reversal in 2023 with roughly two rate cuts priced in. We don't see that happening. And this kind of gets back to another bit of an issue is that I think we talked about being used to what happens at the debt ceiling. I think market participants are also used to what happens when the market gets in trouble, when the economy gets in trouble, and that the Fed cuts, that reaction function that the Fed typically has. That's going to be difficult to react the same way that they've done in the past with low levels of employment, with still elevated levels of inflation. My point being, I think the Fed is willing to experience a bit more economic and market pain than maybe what we've been used to in the past before they adjust monetary policy to make sure that this inflation issue is settled.
All right, well, we're going to have to put a bookmark into our conversation. Love having you on as per usual. Jim Schmigel, thank you so much for the time today.
Thank you.
Meantime, we are just getting started here on Yahoo Finance Live. Coming up, what should investors be watching for with Tesla's shareholder meeting kicking off later today? Plus, how will summer travel demand impact gas prices? Drivers could be in for a crude awakening. And stay tuned for our very own Jennifer Schonberger's conversation with Senator Elizabeth Warren. That's a first on Yahoo Finance, coming up at 3:30 p.m. You don't want to miss it. The Federal Trade Commission is suing to block Amgen's deal to acquire Horizon Therapeutics, and this stock is sliding on the news. Yahoo Finance's Anjali Kamlani has the details. Anj, take us through this.
That's right, Dan. So we got the FTC suing, or at least saying in a statement that it is suing to block this deal. That would be the potentially $28 billion acquisition of Horizon Therapeutics by Amgen, big pharmaceutical giant. And what it would do is really add 2 orphan drugs to Amgen's pipeline. That's for rare diseases. The FTC is concerned about competition here, saying that that Amgen could leverage its market power with PBMs and really benefit these 2 products. Meanwhile, analysts are basically saying that they're concerned because it's not based on overlapping products, which is where competition wouldn't necessarily come in. In a note from SVB Securities, the analyst said, quote, "There does not seem to be a strong rationale that the FTC can justify that this specific deal would be an anti-competitive in nature in our view." That comment was sort of echoed by other analysts as well. The FTC did state in a statement today that today's action is the first to challenge a pharmaceutical merger in recent memory, sending a clear signal to the market that the FTC won't hesitate to challenge mergers. And this is something that we have seen the FTC sort of lay a stance on, which is trying to block the competition, trying to block monopolies, and really focus on the pricing pressures that this ends up, being a problem. In its response, Amgen did say that it is going to fight this, of course, saying, quote, that the FTC's claims that Amgen might bundle these medications and offer them in a multi-product discount, that's through the PBMs for favorable placement and the like, at some point in the future is entirely speculative and does not reflect real-world competitive dynamics, and they've committed, as has Horizon, not to bundle. So already a lot of discourse around this, and we will obviously have to wait and see what happens. The deal is set to close in mid-December, and analysts are saying that this could at least delay it by 6 months or so if it doesn't get resolved before then. The companies could end up terminating at the end of that time, or they could end up moving forward and going through a trial. So all depends, all wait and see. This is an interesting one to watch because it has broader implications for the overall pharma industry. We know, of course, Pfizer and Seagen just filed for their deal with the FTC to close. That's $43 billion. So a lot of big deals on the table right now.
All right. Thanks so much for breaking that down, Anjali Khemlani. All right. Meantime, heading into Memorial Day weekend, drivers are getting some long-awaited relief at the pump. The national average now sitting at $3.53 a gallon. That's according to AAA. That's down about $1 from this time last year. Joining us now is Patrick DeHaan, Gas Buddy, head of petroleum analysis. So take us through what we can expect as we're heading into the summer travel season.
Well, continued relief, barring unexpected outages at refineries or major hurricanes. The national average price of gasoline likely to be over $1 a gallon lower for much of the summer compared to last year. In fact, according to our numbers, we just hit that level. We fell to $1 a gallon deficit from a year ago. That's only the 4th time in history that we've seen such a dramatic drop in year-ago prices compared to a year ago. And so consumers are going to be the bulk beneficiaries. Americans today spending $380 million less on gasoline than a year ago. Certainly good news, and the good news doesn't stop there. The price of diesel also dropping. In fact, now it's at its lowest level since March of 2022. Both gasoline and diesel prices likely to remain pretty low this summer compared to where they were last year.
What about the willingness to shell out the money? I mean, we realize that there's been some relief, at least in gas prices, but to what extent are you finding that consumers are willing to pay in this tough environment in terms of taking road trips? I mean, how is the demand likely to compare to where things were last year?
Well, ironically, I think demand could weaken this summer compared to last year. Even in the light of gas prices, that could be 25 to 35% lower. And I think a lot of that has to do with anxiety over the economic situation, a potential recession, the Federal Reserve raising interest rates. A lot of the stories people are watching doesn't really make them feel terrific on going out and hitting the road this summer. So by and large, demand has been a little bit of a laggard this year compared to last year. And that's a trend that could continue through the summer driving season. So don't expect as many Americans to hit the road, given some of those economic headwinds, even with lower gas prices.
Yeah, and there are signs here that there could be potential headwinds or more headwinds moving forward. We heard from the IEA today talking about what demand is likely to look like moving into the second half of the year, specifically on oil. They said that demand is likely to eclipse supply by 2 million barrels a day because of the stronger than expected demand coming out of China as they continue their reopening. What does that mean broadly in terms of gas prices, and how significant is the risk to the upside?
Well, that certainly could be something to watch for the second half of the summer. I think the market is overly pessimistic right now. Inventories are not terrific when compared to a year ago. Distillate inventories are only 2% above a year ago. I think the big difference right now is the overall sense of sentiment is rather low across the United States. So if we do start to see growth coming in the United States, and especially in China, we could be in for a crude awakening, as oil prices could stand to rally again in the second half of the summer, depending on those economic headwinds. If they lighten up, we certainly could be in a bit of trouble, as inventories globally still remain tight, especially with OPEC's ongoing production cuts.
Okay, Patrick, I hear you, and I like the little pun there, crude awakening. But what I find interesting is I've seen some data saying that there's an expectation that more people will be flying versus hitting the road. But more often, at least anecdotally, I hear is people are still, if they're going to cut costs, they're going to cut it on flying, and they will hit the road. People really do like their summer travel. Do we really think that there is going to be that much of a cutback this summer compared to last summer?
I wouldn't say it would be significant. We're probably talking the low single digits, maybe a 2 to 5% drop. But as you mentioned, I think conditions have improved to jump on a plane. More airlines have added capacity in the form of additional planes. So there is more capacity, and the price of jet fuel is down. So airlines are getting a little bit more competitive because of those additional seats. So, Americans may be more able to jump on a jet given the potentially falling price of fares this summer. But again, I think gasoline demand is going to be a little bit off of its peak a year ago. And a lot of that still has to do with anxiety over which way the economy is heading and continued layoffs, even though jobs numbers do look pretty good.
I want to get back to what you said,
Go.
Patrick, about the demand picture. When you look at things globally, not specifically just in the U.S., when you say that we could see higher prices going into the second half of the year, I mean, what's the expectation consumers should have?
Well, I think right now it's very tough to pin a forecast down of where we're going to be in the second half of the summer, because I don't think anyone really knows when the Fed is going to hit pause permanently and how quickly any rate decreases could come. I think that could be a catalyst for an increase in demand. If suddenly that sentiment shifts from pessimism to optimism very quickly, we could see oil prices rally. But that's the million-dollar question is, will the Fed act as a catalyst by cutting rates too early? A lot of the Fed chairmen and regionally at the banks across the country are suggesting that we probably won't see cuts yet. So I think consumers should be a little bit wary about potentially hitting the road in the second half of the summer, given the wide range of potentials. But I think the odds based on the Fed are still against that rally happening in 2023.
Patrick, so the Biden administration earlier this week, well, literally yesterday, announced plans to tap the SPR, the Strategic Petroleum Reserve. What does that signal to you with regard to fuel and what will happen with the sector and with gas prices?
Well, the front month contract for WTI is still back around $70 a barrel, and there's a lot of contracts well beyond that stretch below $70 a barrel. So the government looks poised to potentially start refilling, because its strike price is here now and into the months down the road, especially when demand is likely to weaken later this fall and winter. So I think the government is well advised to start refilling the SPR, especially in the geopolitical climate we're in. And this is not a bad window to start getting those things in order to refill the SPR. I don't necessarily expect that 3 million purchase to be successful yet. Keep in mind, the government is going from a market price auction to a fixed price. There may be some complexities, but I do expect that in a matter of time, the government will start to refill the SPR, given the value of the SPR and given the value of having an insurance policy against countries like Saudi Arabia and Russia.
Yes, buddies. Patrick DeHaan, always good to have you on the show. Really appreciate the time today.
Thanks for having me.
All right, blue chip stocks have been under pressure as investors fret about debt ceiling negotiations and weaker than expected results from Home Depot. Joining us now to take a look at some of the market action from the floor of the New York Stock Exchange is Yahoo Finance contributor Remy Blair. Remy, take it away.
Well, as you mentioned, ahead of the closing bell, we are seeing mixed trading for the major equity averages. The Dow Industrials and S&P 500 remain in negative territory. As for market-moving stocks today, let's start out by looking at SAP. Now, shares are higher today as the company kicked off its annual Sapphire conference in Orlando, Florida. The company announced that it announced a share buyback program of up to 5 billion euros, and also taking place at the event, SAP provided an update to its 2025 ambition. Now, that is the company's midterm financial release that reflects both its expected divestitures of Qualtrics and also reflected strength in cloud momentum for the company. In terms of other companies seeing major market moves today, AMD shares traded higher, and this did come on the heels of news that Daniel Loeb's Third Point took up new positions in Advanced Micro. Shares were higher by as much as 5% on the session, and according to a regulatory filing, the hedge fund has a stake of 1 million shares in the chipmaker. Heading into the close, shares of AMD do remain higher. Last but not least, let's take a look at RH. Now, that is the company known formally as Restoration Hardware. Shares fell by as much as 8% on Tuesday, and this did come on the heels of Berkshire Hathaway releasing its 13F. And in that regulatory filing, the company, which is owned by Warren Buffett, eliminated positions in RH, as it also trimmed stakes in other companies. As for stock market action for that stock in RH, we did see shares close above $260 per share in the previous session. But today, as we head into the closing bell, we are seeing RH shares lower, down below the 250 share level.
Remy Blair joining us from the floor of the New York Stock Exchange. Thanks so much for that. Well, coming up on the other side, Yahoo Finance's Jen Schomburger chats with Senator Elizabeth Warren. That is a first on Yahoo Finance. You certainly won't want to miss it. We'll be right back.
We got an inside look at the industrial economy here at Goldman Sachs' Industrial and Materials Conference. We heard from the biggest names in the space, including the CEOs of RXO, Clean Harbors, and Johnson Controls. Here are our 3 big takeaways from the event.
First up, artificial intelligence, AI, the buzzword that's got Wall Street's attention. It's starting to transform the industrial sector, with more companies jumping on board.
We've been investing in AI for over a decade. And so if you think about the pricing algorithms that we've got that allow us to have best-in-class margins, it's because with every load that goes into the system, our algorithms get that much smarter on a pricing perspective for both the customer and the carriers. We're also using AI for customer integrations. What we see is that we're able to have our employees be able to do more per day.
A bull market awaits. It's almost like, what recession risk? The industrial economy is seeing signs of a recovery.
Today, we're in the start of a very significant, infrastructure build in the U.S. Some might call it a U.S. manufacturing renaissance. The level of spending that's occurring today is unprecedented. And so the tone coming out of the conference the last 2 days has been very bullish.
Worker shortage. Business leaders are having trouble hiring and retaining top talent.
We've had trouble. Our turnover, it's not just hiring people, it's retaining the people we have. And lowering our turnover rate down to pre-COVID levels, which has been terrific. So in my mind, I think it's as important to keep our own employees and provide a good career path for them as all it is to hire more capable bodies. It is improving, more holidays, better healthcare costs, providing a career path for our employees.
SVB and Signature Bank executives testified about the lead up to the failures of each firm before the Senate Banking Committee. Joining us now is Yahoo Finance reporter Jennifer Schonberger, who is joined by Senator Elizabeth Warren, who got to grill these former executives on the Hill today about the issues leading up to the failure. Jennifer?
Thanks, Diane. And Senator Warren, thank you so much for joining me. It's wonderful to have you on the program.
Thank you.
So you heard for the first time today from the CEOs of failed Silicon Valley Bank and Signature Bank. Your reaction, Senator, what was your biggest takeaway?
These guys just showed us exactly what is wrong with banking right now at these multi-billion-dollar banks. So the last time those very same people were in front of us in the banking committee was when they came to lobby to weaken the bank regulations. That was back in 2016. In 2018, they got their wish. And as soon as they got their wish, they loaded up their banks with risk. Silicon Valley Bank decided, just to take on a whole lot more risk. They get a bunch of flags from their banking regulators saying you're taking on too much risk. And you know what their response was? It was to pay themselves big bonuses and stock options. In fact, the CEO of Silicon Valley Bank's salary went up 35% in the year that they took on a whole lot more risk. And these CEOs kept paying themselves. And then when their banks blew up, their plan is to keep all the money. And that's what the final questions were about today. After all, as I put it to Gary Becker, the CEO of Silicon Valley Bank, you made millions, tens of millions of dollars. We went through the numbers by loading this bank up on risk. When the bank exploded, it cost the FDIC billions of dollars. So how much out of those bonuses that you paid yourself are you planning to give back to the FDIC? And the answer was nothing. Plans to keep it all. And that's why I am advancing a bill with good, strong bipartisan support in order to claw back money from these bank executives so that if they load up on risk next time around, pay themselves, explode their banks, that they will lose all of that money that they paid themselves for exactly taking on that risk. The idea is let's get those incentives aligned a little better, not to blow up your bank.
What's your sense of bipartisan support in the full Senate for that clawback bill? Do you think you could get this legislation passed here in short order?
I do. I have good partners in this. When I first started, I started on the Democratic side with Senator Catherine Cortez Masto, and we started on the Republican side with Senator Hawley and Senator Braun. So we started 2 and 2 as we got it going. Now we're in the banking committee. We've got a lot of Democrats committed on this, but we also have a good group of Republicans. We haven't gotten everybody signed on the dotted line, so I don't want to name names here, but I feel very optimistic that we're going to have a good group of people, and all of us are asking Chairman Brown to let us mark this bill up. As you know, that's what we do in the committees, so that we can send it to the floor of the Senate. I think it's going to get good support. I think it's going to make it through.
Well, keep us posted on that, Senator. Silicon Valley Bank's former CEO, Becker, and the board knew about these 31 regulatory infractions when he sold stock options just 11 days before SVB failed. When asked about this in testimony, he did not think that he was in possession of material non-public information, even though he had not disclosed that to the public. Your thoughts on this? Do you think Mr. Becker committed insider trading?
Look, it is clear to me that there is enough that was said in this hearing today that there needs to be a full investigation of insider trading for Mr. Becker. But I just want to underscore here that one of the remarks at today's hearing from the CEO was to say, well, you know, in my judgment, it was good management running the bank. And you just want to say, your judgment is just laughable here. The idea that you can just sit there in your full, straight and starched way and say that, you actually blew a bank up, a bank that had a lot of business, a bank that was getting all kinds of warnings from the regulators that you had taken on too much risk, and then want to claim that you use good judgment in running that bank, and then want to turn around and say, but you didn't have any knowledge about what was really happening when it comes to terms of insider trading. Look, the bottom line here, it's all about how could they boost short-term profits, then take out money for themselves personally, and then keep all that money when the bank blew up. And that's the part Congress has got to put a stop to.
We saw JP Morgan gobble up First Republic Bank just a couple days ago. Treasury Secretary Yellen says we could see more mergers in the mid-sized regional bank space, given the pressure that we're continuing to see here on regional banks. She says regulators would be open to that. Your thoughts on that, Senator? And do you worry that the nation's largest banks are only getting larger here and creating more potential systemic risk?
So I like the way you frame this. Let's just back this up to look at what it means overall in our economy. President Biden's signature move for our economy has been to say he wants more competition and less concentration. And that's true when we're talking about meat packing, and it's true when we're talking about eggs. It's true wherever we're talking in this economy, including when we're talking about banking. And why with banking? Remember, back in 2008, 2009, the reason that those gigantic banks had to be bailed out was because of concentration. They were too big to fail. The regulators were willing to say the little ones could fail, but not the giants. So we now have to understand that weak regulation has left a lot of these multi-billion-dollar banks on shaky grounds. In order to put them together and create more concentration in the banking industry, that is not a happy solution. That is a bad problem made worse. We already have too much concentration in the banking industry. And in the specific case of JP Morgan Chase, what happened is that weak regulation let these CEOs load up on risk, pay themselves, banks explode. And that means that a poorly managed bank got gobbled up by the largest bank in this country, which is now $200 billion bigger than it was before this problem started. So this reminds me, what do we need to do? Well, we need that clawbacks bill just to get our folks aligned better so that the CEOs have less incentive to load up on risk. We also need the Fed right now to be ratcheting down, using their discretion to ratchet down on bank oversight and regulation. And we need Congress to roll back those changes from 2018 that gave the Fed the ability to weaken regulations. In other words, we need to get focused on this banking industry. We need to be tough on this banking industry, and we do not need to see making too big to fail banks even bigger as the solution. It's not.
Switching gears, Senator, President Biden is meeting right now with House Speaker Kevin McCarthy on the debt ceiling. Do you think the president is giving away too much by putting things like work requirements on the table, or perhaps looking at shorter-term spending caps? Are you worried that he has not heeded the lessons from raising the debt ceiling in 2011?
So let's think of this in 3 bites. The first bite is that we should not negotiate over the debt ceiling. The United States government pays its debts, full stop. And it is wildly irresponsible of the Republicans to threaten not to pay those debts, to threaten to push our economy into a recession, to put millions of people out of work, and to damage our good name all around the world, where literally since the beginning, the United States word was as good as its bond. And so that's number one. But number two is we can negotiate over budgets and spending going forward. But if those Republicans are really serious about reducing the national debt, then let's start by raising more revenues. Let's start by closing 12 loopholes that President Biden identified yesterday. Let's start by saying billionaire corporations and billionaires should at least pay a fair share. You know, I don't think it's right that Jeff Bezos, one of the richest people in the world, pays less in taxes than an Ohio steel worker or a Boston public school teacher. Not less proportionally, less in actual dollars in federal income taxes. That's fundamentally wrong. But you ask the question about what about work requirements? I just want to be clear. We're not really talking about work requirements. Right now, for example, on Medicaid, more than 90% of the people who are receiving help either are already working or they are exempt from working because they are disabled, because they are taking care of an infant, because they have a serious long-term illness and are unable to work. So what is this really about? Well, we've learned from past experience. It's about putting a whole lot more requirements, a lot of red tape, that the red tape itself will get people tangled up so that they don't get the benefits that they are actually legally eligible for, benefits that they need. And we have data on this. The state of Arkansas decided to put these tough new work requirements in place. And the consequence was not to get anybody additional working, but it did have the consequence of so tangling people up in red tape that many of them got pushed out of the system. So this is really about Republicans just trying to find a way to keep people from getting the medical care that they need, keep them from getting the food that they need, and just push them out onto the streets. And if that's what they want to do, put it up for a vote, and let's see what the American people say about that, because that is fundamentally wrong.
Senator Warren, unfortunately, we'll have to leave the conversation there, but so appreciate your insight. Please keep us posted on your work on the regional bank front. Hope to speak with you again soon.
Will do. Thank you for having me. Always good to talk with you.
Thanks so much. That's Senator Elizabeth Warren. Akiko?
Our thanks to Jen there for bringing us that conversation. Our thanks to Senator Warren as well. Well, coming up next, we're going to count down to the closing bell with some of today's top trending stories and tickers. Stay tuned.
As we continue to wind down the trading day and count down to the closing bell, let's take a look at some of the top trending stories of the day outside of some of the big ones we've been covering. Banking sector story that caught my eye is this: Wells Fargo announcing it has finally settled a shareholder lawsuit tied to that fake account scandal from 2016. That feels like so long ago because we're looking at other banks now. Now with Wells Fargo, this agreed on price tag is $1 billion. Shareholders accused the bank, you'll recall, of misleading investors about how quickly Wells Fargo worked to address those problems and risk management failures that led to that debacle. For anyone who does not remember, this was the scandal where it was discovered that the company employees there were opening up fake accounts, including debit and credit accounts and customer names to reach certain sales goals. And I don't know if you all remember that there was this 8 is great term about, the number of accounts they wanted to open up.
And one thing that's interesting with this too, Diane, is to think about the other industries or other companies, I guess, this can impact too, right? You go back a couple months and Hindenburg Research was essentially accusing the same thing of Block, right? They said that Block had too many accounts that weren't actually real, and basically saying how many of those accounts are real, because when we talk about investor accounts and just overall accounts at a bank or at a company like Block or at a company like PayPal, that's what people are looking for, is what's that revenue per customer. Right. So interesting to see this solved today, Akiko, though I don't think the market was overly interested in it. Not a large move from Wells Fargo today, but certainly an interesting story.
Yeah, Josh, I saw this story and you sort of go back to, okay, well, this is just the latest in a very long list of settlements Wells Fargo has had to move forward with in issues that date back all the way to 2002. Obviously, we don't want to conflate all of them, but even within the last 6 months, we're looking at a settlement of $3.7 billion paid out in December 2020, $3 billion settlement. That was about allegations of consumer abuse, but there have been a long list of settlements for Wells Fargo. Feels like they just can't get out of the shadows of what happened before, but certainly yet another step that allows them to move forward because their reputation was hit in a big way, and that's kind of putting it mildly.
Right, majorly. Akiko, you'll recall Senator Elizabeth Warren, who we just did an interview with, held then CEO John Stump's feet to the fire over that, and I remember him just stumbling through his testimony at the time, banking executives have gotten better at handling this kind of thing. And obviously, the banking executives that we saw today was a different situation. We're dealing with collapse. That was an out-and-out scandal, the Wells Fargo situation. So it's interesting just to see a different banking story today when we have some bank executives on Capitol Hill.
Yeah, there just seems to be this turmoil overall in the banking sector. And Akiko, like to your point, this isn't the first time that Wells Fargo has been involved in these controversies. So you hope that you can move forward and that this doesn't happen again.
Let's move on to another story, a bit of a pivot, guys. But one story I'm watching today has been this global race to attract green investments. The latest headline here coming out of France, introducing a bill that would rival the Inflation Reduction Act here in the U.S. The country setting aside tens of billions of euros in tax incentives to accelerate the development of clean energy. It also doles out bonuses for electric vehicles based on, number one, the energy makeup of the country where they're assembled. Number two, the carbon footprint of the parts, as well as components, and then of course how much of those parts can be recycled. And if this sounds familiar, it's because so much has started to move as a result of the IRA being passed here in the US. And I want to point to a comment, guys, we got from the French finance minister Bruno Le Maire, who said there's a new, more brutal form of globalization in which everyone defends their own interests with few scruples, and the US and China are in a merciless technological, economic, and financial rivalry. His point being that Europe has to play in that as well. And if you look at all of the investments we've talked about since the IRA, this is kind of the new norm. If the US passes a big package to attract onshoring of manufacturing, then Europe responds with another one. And we've sort of seen that in the chip space as well.
It's true, Akiko. And one thing I thought was interesting, there was a chart that I saw within this Bloomberg piece about, I didn't realize that only 10% of France's GDP was produced by manufacturing. So there's certainly room for them to try to gain some ground there. But to your point, right, you've seen different geopolitical, in different countries try to just go inward and, claim some territory.
And part of it's
there.
about what that funding allows these companies to do, right? You look at a company like First Solar that is expected to really benefit from the IRA. And just yesterday, Akiko, they bought a European company and the stock soared significantly on that news. If you take a look at a 2-day chart of First Solar, it went up massively over the last couple of days because is expected to benefit from the Inflation Reduction Act. So when you think about what this means for some of the companies, First Solar hasn't necessarily seen it actually in their earnings yet. They were talking about that a lot a couple weeks ago, but they do think it's coming down the line, and that stock has been on a wild ride for over a year now because of how it can benefit from that government involvement.
Yeah, I think looking at those stocks in the back half of the year is going to be really interesting to see how that plays out in terms of those investments. But yeah, Kiko, going back to that French minister quote, I mean, brutal form of globalization, no scruples. It was very intently worded. And I do think this just goes back to that act being passed and how the U.S. has really set the precedent here that others will follow. Moving on, though, to a stock and a story that I want to highlight. Comcast CEO Brian Roberts fairly confident that the company will sell its minority Hulu stake to Disney. Here's a bit more of what he had to say during MoffettNathanson's telecom conference earlier today.
The fact is that Bob Iger on his earnings call last week said that they're, now back interested in general entertainment, and which is no surprise. And I think it's more likely than not that we go through what we've said all along, that the vast majority case is that they'll call, and at the beginning of next year.
And remember, guys, Disney currently owns 2/3 of Hulu, with Comcast Universal controlling the rest. Under the terms of the joint ownership agreement, Comcast could require Disney to buy out its stake in the streamer as early as January 2024 at a guaranteed minimum equity value of $27.5 billion, or about $9.2 billion for that 33% stake. But Roberts saying at that conference that he thinks they're going to be able to sell it for a heck of a lot more than that.
Well, look, on the earnings call, Disney's earnings call last week, Iger had said that he'd had talks with Roberts, with Comcast, about that stake, and he'd said the talks were quote, constructive. So it definitely sounds like this seems to be the path that they're moving forward. But in terms of timing, Comcast had thought this would happen before now.
Yeah, and then you're really looking at that 2024 date now, it seems like, from as far as what's going to happen in the future. And I just think beneficial to shareholders is what you highlight here, right, Akiko, as far as what matters moving forward for Comcast, basically saying Hulu is a good asset. We're kind of trying to figure out what's going on with our own streaming service, Peacock. Maybe it's best for us to unload this at a high value and figure out what's going on with Peacock. Akiko, I know you and I talked plenty about sports streaming. I couldn't believe Peacock paying $110 million for one NFL game. I mean, what is going on with Peacock right now?
That's a whole nother conversation,
I can't believe what's going on with Peacock.
but look, Allie's point here, $27.5 billion valuation, right? I mean, that was in 2019. The expectation, at least from the comments we got from Roberts today, appears to be he thinks it could go for a lot more. 50 million subscribers, or roughly 50 million subscribers. I am curious about that price tag because you have to wonder how that sets a precedent when you look at the rest of the streaming landscape. They're commanding a lot higher, but they're also struggling in some way.
Yeah, it's certainly an interesting space, and I don't know if we're going to get any clear answers on what happens with Hulu in the near term. But I do want to take a look at another stock here on holding. Shares of the rising footwear brand sliding today despite an upbeat earnings report. The company posting sales up 78% from the year prior and boosting its full-year sales guidance, but it is expecting revenue growth to slow in the second half of the year compared to the first half of the year. So they saw revenue growth in the mid-50s for the first half of the year. They're projecting closer to the mid-30s in the second half of the year. Still mid-30s revenue growth. Yeah. Pretty impressive.
I know.
And you're talking, but I think really what happened here is you're talking about a stock that basically doubled to start the year.
Yes.
And that's what a lot of analysts were pointing to, Diane, as far as why you might have saw a downward move.
Yeah,
today.
I know. I still was surprised by the dramatic slide today.
Yeah.
I mean, it's certainly not, it's not sprinting today. I had to throw in a pun.
You had to put in the pun.
I had to, Akiko. I'm sorry. I had to, But I mean, I see the shoes everywhere. And though we've seen some of the athleisure lose some of steam from the pandemic, On still seems to be on. So I was surprised that how Wall Street dinged it today.
And Wall Street overall, the analysts at least, they're very bullish on this company moving forward. We had a note from Wedbush that said, quote, On is one of the strongest growth stories in our space with great products that are gaining brand awareness, gaining new points of distribution, and selling predominantly at full price. But guys, I think I might be a little uncool here because I don't really know this brand.
Are you serious?
I'm literally serious.
Allie, so how do you not know On? They're everywhere.
I think I literally felt really not cool.
Allie,
Allie is not a runner.
I'm not a runner.
Okay, and I'm not either because I have heard this from runners who say it's just, forget the style of the shoe. It apparently is the best shoe to go running in, that it's comfortable. So I have never tried them. So we're in the same.
Runners do like them. I've tried on I think one pair, but I like Brooks better. Yes, those
the
are
Roger Federer shoes are becoming kind of office wear too. So it'll be interesting to see if that's
okay. Well, I gotta go and get myself a pair.
Okay, we'll both make an appointment of that, Allie. But interesting to see that stock move today because it does feel like investors are looking at any kind of sign, any hint of a pullback. That's where we've seen the pressure build, not just on holding, but on other companies as well, because we're still trying to get a pace of or a sense of where the retail mindset is or the consumer mindset is. All right, moving on here. Tesla's 2023 shareholder meeting is about to begin. Yahoo Finance's senior autos reporter, Pras Subramanian, is here with what to look out for. Pras.
Hey, Kiko. So main things here, mostly we're talking about a couple things like shareholder items like votes on certain activist proposals, but mainly we're talking about election of board members. JB Straubel, former co-founder of Tesla, is back nominated for a board seat. We'll see how that goes. And chairman of the person on the board, Robin Denholm, also up for a vote. We'll see how that goes. Well, there's been some talk that there's concerns that she is not really monitoring Musk that well, and they'd like more from the board there. Speaking of Musk succession planning, also on the agenda potentially. Some investors have highlighted key man risk with Musk being there. Is there a plan in place to actually have someone kind of be the heir apparent? Tesla is concerned that if you kind of name someone who is an heir apparent, they could be poached by another competitor. Also, in investor meetings past, we've seen them talk about their product roadmap, what they're going to come up with. We've heard about the Gen 3 platform. We've heard about recently the Tesla Model 3 Highland, the rumored update to that. So that might be discussed there. And also, will Musk discuss interesting things like demand, supply, pricing strategy? That's all been very, very top of mind recently for investors as this price of these cars have been coming down tremendously. And whether he'll be spending more time at Tesla or at SpaceX or at Twitter or wherever else, hopefully for investors, mostly at Tesla.
Yeah, pricing strategy, one that's going to be really interesting to hear what Elon Musk has to say, because that has been the concern, especially with the EV market increasingly crowded. Pras, I know you're going to keep a close watch on that. Thanks so much for bringing us that preview. Let's do a quick check of the markets as we count down to the closing bell here. As we see red arrows across the board, the Dow down more than 300 points, the S&P 500 down 25, and the Nasdaq down 19. And as we watch today, certainly retail in focus there with worse than expected retail earnings out, as well as retail sales. Well, investors are certainly not liking Home Depot's earnings report today as we see the closing bell today. The stock closing down after the retailer reported a decline in revenue and cut its full year EPS and revenue growth projections, citing demand weakness in Q1 and expectations that the weakness will continue. Doesn't look good as we look ahead to Lowe's earnings next week, Dan.
No, definitely. That was definitely one of the drags on the market today. Home Depot, you had also the backdrop of the weaker than expected retail sales numbers. You're looking at Home Depot down 2%. That knocked on Lowe's as well, as investors taking that stock taking a hit as well, down about 1%. You also had the debt ceiling backdrop hitting the market as well today with those talks going on. So certainly just seeing pressure across the board. Initially, the Nasdaq was the outlier, but again, all three indexes falling at the close, and Home Depot just giving a cautious outlook, although their earnings revenue fell. Earnings were better than expected, but revenue missed expectations broadly. So again, just not boding well for Lowe's ahead of it for Home Depot, biggest revenue miss in more than 20 years, lowering its forecast for the year. Another stock that we're watching today, Horizon Therapeutics, that stock taking a big hit. It's sinking double digits, down 14% after the FTC sued to block Amgen's acquisition of the biotech. The government says the deal would stifle competition, arguing it would deepen Horizon's monopoly on treatments for thyroid eye disease and chronic refractory gout. Now, this marks a big stake in the ground by the FTC because, Akiko, it is the first time the government has sued to stop a pharma deal since 2009.
Yeah, and that was a bit of the surprise there. I mean, look, if you look at FTC Chair Linda Khan, we know that she has been very clear about any kind of sort of anti-competitive behavior. They've been very cautious on any type of merger deals there. But so much of the focus has been on the big tech deals. At least we've been focused a lot on that as well. But when you look at what happened today, Horizon Therapeutics getting hit in a big way on the back of that report, down well over 10%. We should note a federal judge still needs to approve the injunction. So this is not a done deal by any means. But now that deal potentially in danger, and Horizon Therapeutics down more than 14% today. On the news. Well, chip stock AMD is trading higher today, closing up. The stock boosted after Daniel Loeb's Third Point reported a stake of 1 million shares in the chip maker. AMD, of course, not the only chip stock on the move today. And Nvidia also trending today on Yahoo Finance, news that it now has a larger market cap than Berkshire Hathaway, and you see the stock up about almost a 1% there, trading at $292 a share.
But AMD had that bigger move, up 4%. And you also had some interesting comment from Bernstein analysts about AMD, talking about, yes, the PC market is still bad, but less bad now. And then you really have to kind of compare the PC market to pre-pandemic. You can't use the pandemic as a frame of reference now, and that things are normalizing with regard to PC shipments. So hence helping give a lift to AMD as well. So, you're seeing that play out as well within that stock. I want to switch gears now and talk about AI. It is center stage in Washington today, with OpenAI CEO Sam Altman testifying before the Senate Subcommittee on Privacy, Technology, and the Law about the challenges and need for standards surrounding the rapidly developing technology. Joining us now for Insight is Kyle Wiggers, a senior reporter who covers AI at TechCrunch. Kyle, thanks for joining us. Let's get right into this and talk about, first, what was your initial takeaway from today's testimony?
Sure. First of all, thanks for having me. Today's testimony covered a range of topics, for sure. It included Sam Altman, the CEO of OpenAI, which created the viral chatbot ChatGPT, which I'm sure many of your viewers have heard of. Also participating was IBM Chief Privacy and Trust Officer Christina Montgomery and Gary Marcus, a former NYU professor and expert in these types of AI systems. They all spoke to the dangers of these systems and the need to regulate them. They weren't always aligned on how to do that, which is telling, I think, because these systems are evolving so quickly. It's hard to predict, and several lawmakers got out at this point, what AI systems are going to look like in even the next few months to year. One idea that did emerge that found some consensus among regulators and those participating in the panel was the idea of an agency that would have the power to give companies a license to deploy their AI and revoke that license if it turns out that they're deploying that AI in maybe an unsafe way or not implementing sufficient safeguards. Altman especially was supportive of this notion and urged lawmakers to adopt some form of it in the future if they so chose to do so.
And the approach that we have seen from many tech executives who've testified over the years about regulation is to say sort of, look, we're ready for it, regulate us. And we sort of took Sam Altman kind of took the same approach today, talking about what that should look like. Take a listen to what he had to say.
I think the U.S. should lead here and do things first, but to be effective, we do need something global. Given what it takes to make these models, the chip supply chain, the sort of limited number of competitive GPUs, the power the U.S. has over these companies, I think there are paths to the U.S. setting some international standards that other countries would need to collaborate with and be part of that are actually workable, even though it sounds on its face like a impractical idea. And I think it would be great for the world.
So Kyle, a few things on that. I mean, number one, to Sam's comment there about how the U.S. should act first. I mean, the U.S. is already behind when you look at the EU, sort of at least in draft form, pushing forward what that AI legislation would look like. But in your conversations that you're having, what are you hearing about what that ultimate regulation should look like, given that this is not something that necessarily has borders? And if you take a fragmented approach, enforcement could be really difficult.
Right, that's true. It's unclear, I mentioned the possibility of an agency being formed to regulate this. What form that agency might take and exactly what their purview might be. There's so many problems that have yet to be resolved around AI, especially generative AI, the kind of AI that can create text and images given a brief prompt. For one, there are data privacy concerns, right? How should companies go about training their AI on data that might be copyrighted or private? That's still being hashed out, and it's unclear what steps Congress might take, if any, to resolve that issue. Then there are questions about copyright. Speaking of whether the output of these systems can be copyrighted. The U.S. Copyright Office hasn't really decided or made it clear in what circumstances you might be able to own a piece of AI-generated artwork or writing. So there are just myriad issues at play here, and I think that's why we've seen kind of limited to no action on the congressional side. The EU is doing its best to attempt to establish a framework, and perhaps whatever happens here will follow that framework to some degree. But again, it's an evolving issue, and it's really hard to regulate something that's such a fast-moving target. Clearly, though, this panel illustrated the strong desire from both industry and lawmakers to take some action.
So, Kyle, there's been some conversation on social media about where Congress is in terms of the cycle. And, let's say you compare this to social media and dealing with the issues that have come up in social media and, say, regulation around that. Do you feel like Congress is at the starting point, or are they already behind when it comes to dealing with regulating AI?
I think it's fair to say that they're behind. Then again, I'm not sure who is ahead, if anyone. The EU hasn't adopted the AI Act, the AI framework that has been in the works over there for quite some time now, years. And we won't see it go into effect for, who knows, it's indeterminable. Several lawmakers involved in the panel today mentioned the fact that maybe Congress has been slow moving on this, especially as it's beginning to trickle into the real world and affect people and perhaps even eliminate jobs, albeit create new ones, depending on who you believe. There is a belief, I think, among many lawmakers, and not just in the U.S., that regulation has to come into effect. But there's a lot of debate over whether that regulation means the creation of a new agency, or it means total restrictions on certain types of AI that might be dangerous. For example, AI that might put out misinformation into the world, especially around elections. I think Altman mentioned that during the panel. That's one of his bigger fears about AI. Go ahead.
To what extent has Europe already set the standard, though? I mean, isn't so much of this about who comes out first in creating a regulation and sort of the U.S. being able to build on that?
Right. I think the EU has provided an excellent framework, in fact. I'm no expert on the intricacies of that framework, but I do know that it categorizes AI into safer forms of AI that then are regulated more lightly, and more harmful types of AI potentially, including AI that might be used to decide whether or not a person receives a loan. That would be regulated a bit more closely, and there would be more restrictions around how that sort of AI could be used. I personally believe that laws here would do well to follow some of what the EU is proposing. As for the creation of an agency like Altman and some lawmakers today proposed, I don't think we have enough details to say whether or not that's a good idea. The ideas floated today were very high level and lacking in that sort of detail that's necessary to determine whether or not that's a good decision. I expect this will be the first panel of several to come touching on this topic.
All right, Kyle Wiggers, the real Kyle, and not an AI of TechCrunch. Thanks so much for joining us today. Coming up, Beam Global's higher today on earnings. We speak to the CEO on the other side.
Well, Beam Global closing higher today. The sustainable EV charging solutions company reported its Q1 revenue on Monday. That increased 245% year over year to $13 million, beating consensus estimates of $8.34 million. You see the stock up more than 5% today. For more on a breakdown here, let's bring in Desmond Wheatley, Beam Global Chairman, CEO, and President. Desmond, we should point out some of your competitors, at least in the charging space, all down, whether that's ChargePoint or Blink in the session today. You've kind of had the perfect storm over the last year when you think about higher gas prices, more awareness on EVs, and so much build out, especially with the IRA in terms of the infrastructure. To what extent do you see being able to sustain that momentum in face of what's happening today, whether it is gas prices coming down or consumers being a little more cost conscious?
We're seeing nothing but more and more growth and more acceleration of growth in our future. In fact, I don't see any end of it for many years to come. We are definitely looking at an electrification of transportation. Our products, actually, we don't compete with the EV charging companies. We support all of them because our products just provide a form of infrastructure that just requires no construction, no electrical work. You never get a utility bill. And crucially, we continue to charge electric vehicles during blackouts or brownouts. This is, of course, very important in Europe as well at the moment, where people are very concerned about energy security after what's going on in Ukraine and with Mr. Putin. But nothing but growth ahead of us at the moment.
But Desmond, Diane here, your business hinges on EV adoption, and there was this expectation that we'd be further along with regard to electric vehicles. For instance, I don't have one yet. I do want one eventually, but we've seen some data recently, as Akiko has talked about, with people holding on to their gas-powered vehicles longer. What is your expectation? What are you preparing for in terms of the road ahead for EV adoption?
Better than half of our revenues come from government sources. We know that the federal fleet is going to electrify all of its 645,000 vehicles by 2035, and in fact, all of its light-duty vehicles by 2027. I think the infrastructure has to come first, honestly. One of the big reasons that people are not adopting electric vehicles is because they're concerned about range anxiety and lack of infrastructure. We're in the business of providing that infrastructure very quickly, as I said, without construction or electrical work. So we're solving a problem which, frankly, is massive. I mean, it's a massive opportunity, but we're going to have to build out all the charging infrastructure in the next couple of decades. And I think that will probably require something in the order of 60 million publicly available plugs to fully electrify the United States. So it's a huge opportunity.
Desmond, to pick up your point earlier, you do differentiate yourselves because you don't necessarily need to power to the grid as opposed to some other charging stations in terms of how Beam operates. Are you finding that increasingly cities, governments are thinking about this differently? In other words, it's not just about building out the charging stations. It is about thinking about this more holistically because the resources are still limited when you think about the overall infrastructure.
You know, we have a strategic petroleum reserve, which is a very good idea. That's to ensure that we never run out of diesel or gasoline for our ground transportation. But there's no strategic electric reserve. In fact, we're at capacity in many of the markets in which we operate. New York City is our biggest municipal customer. Everybody knows that there during August, if everyone turns up the air conditioning, the power gets turned off a little while. Same thing over here in California where we are. So adding capacity to electrical infrastructure here, the way we do it, which doesn't require a connection to the grid, although all of our products can connect to the grid, is going to be essential. And I can tell you that what we're starting to hear in the halls of Washington, D.C. and other parts of government across the country is that probably at least 25% of all charging infrastructure should be locally generated and locally stored electricity, not connected to the grid, and so that we reduce the vulnerability we have to centralized failures. We know that the Russians have hacked the grid. We know the Chinese and the Iranians have done so. So we need to have charging infrastructure that's immune to those sorts of failures, and that's exactly what we're providing.
And that begs the question, Desmond, why we aren't seeing more of your product out there. What would you say is the biggest challenge right now in being able to scale up in a bigger way?
Yeah, I mean, there's no doubt that in the first 10 years that we were doing this, it was all about education. people were really not very sure about electric vehicles, and they were even less sure about the idea of driving on sunshine, which is what we are enabling people to do. But I think you're seeing that changing very dramatically now. Obviously, the introduction of vehicles like Ford's F-150 Lightning, I drive a Rivian 0 to 60 in 3 seconds. It's just impossible to imagine a future where consumers will select slower, clunkier, more expensive to operate vehicles when they have these magnificent new gadgets to operate. And our ability to provide charging infrastructure very rapidly, very scalably, removing all the uncertainties and cross variations of construction and electrical work, it seems to me it's just a very important thing to be doing. And it's a thing that's come of time. Again, we've been doing this for a decade, but it's only right now you can see the extraordinary growth that we're having. 548% year-over-year growth in orders, 245% year-over-year growth in revenues, and absolutely no end in sight to this. So I suppose our time has come, and now the recognition is there. You're really seeing us take off.
Yeah, I will say, as an EV driver myself, in California, where there is the most concentration of chargers, it still doesn't feel like there's enough chargers really to meet those ambitious targets on EV adoption. Desmond, it's always good to have you on the show. Beam Global's Desmond Wheatley there.
Thank you.
Well, coming up, Wall Street is on Washington Watch. We break down the latest debt ceiling dilemma on the other side of the break. We'll be right back.
Wall Street is on Washington Watch, and the debt ceiling talks are top of mind today. President Biden confirming he will cut his upcoming foreign trip short amid the negotiations. Yahoo Finance's Rick Newman is here with the latest. Rick, take it away.
Well, wasn't that exciting seeing those people in that meeting there? I mean, they're really going to nail this thing down. Yeah, we have another meeting. Okay. Yep. Meetings are not going to solve the problem. Unfortunately, we're going to have to the analysis that I'm seeing basically says is it's going to take market panic to get this done. And until something like that happens, that could be a sell-off in stocks. It could be the bond market going haywire, something like that. I mean, you know, look at the 2011 playbook. That's the template for how this can go seriously off the rails. And the analysis I'm seeing is basically saying until the markets start to say it now is the time to get this done, there's just not going to be an incentive to get this deal done. So this is a very weird moment in markets. It's kind of like everybody.
Well, they think it's going to get done.
Everybody mostly thinks there will be a deal at the end of the day, and this will go away because that's what has always happened before. And yet, in order to get the deal, we have to get the type of market dislocation you would get if things don't work out. So, we are starting to see, it's not showing up in the stock market yet, I don't think, or in the investments most people pay attention to. We are starting to see some dislocations in short-term treasuries. And those, the type of debt that would actually be coming due in the window where we're going to be dealing with this problem, which is, say, over the next 3 months. So that could get a little more bubbly. And it's going to take the politicians in Washington getting a signal from the market that says, guys, this really matters. Can you get the job done here?
Well, I mean, yeah, Rick, that begs the question, what is that? I don't want to use the word panic. You never want to see the markets panic. But what does that look like? If it's going to take some kind of reaction from the markets for lawmakers to step in, you could argue that, look, if you're an investor, you've seen this story before. So there's a bit of complacency in there. What are lawmakers looking for?
Look, this is a political game. This they're framing this as we've got to do something about spending, but they never do anything about spending or about tax cuts that bring in less revenue. They never do anything about that. That's the underlying problem. All they ever do is act like it matters, on these arbitrary deadlines when it comes around every year and a half or whatever that we have to raise the federal borrowing limit. So again, Akiko, the template here is 2011, and we came within like 24 hours of defaulting on some federal payments back then. And here's what we saw in the stock market. In the month leading up to that, the S&P 500 dropped by about 15%. That's what we're talking about here, the type of thing that will get their attention in Washington. And then when we had this is another thing I've written about recently, is what if we had another downgrade of the U.S. credit rating? In 2011, that happened. That actually happened about 4 days after they raised the borrowing limit. But Standard & Poor's said, basically, this was so ridiculous and dysfunctional that we think this political dysfunction actually affects the creditworthiness of the United States. And on that day alone, the first trading day after the credit rating, the S&P 500 fell 6.5% in 1 day. So that is the kind of stuff that gets Washington's attention. Also, for anybody who wants to go deep in the weeds on this, go back and look at the TARP legislation, the bank bailout legislation from 2008.
Oh my gosh, I remember that. That's taking it back.
People may not remember this, but Congress voted down the bank bailout legislation the first time around. And if my memory is correct, that was a 7% down day in the S&P 500.
I don't remember the percentage, but I do remember how
And that's what actually got them around to passing TARP on the second try. So that's what we're talking about here. And before we get to that point, the meetings, there are positive signs and negative signs. This is not going to come together until the very last second.
I mean, Rick, you talk about the risk of a downgrade. We've seen a number of executives already flag that to say we don't have to go up to that X date in order for this to have significant impact on the U.S. as a whole. We talk about this in the context of the markets, but obviously there's a political calculation. In the context of what's about to play out next year, last week you said you had the clock running, 18 months is what we have. What is the calculation on both ends? And to what extent does this even matter from a voter standpoint?
I remain a bit mystified about why the Republicans do this over and over again. I mean, every time. So we have individual members of Congress, the House and the Senate. Sometimes they vote against raising the federal borrowing limit. And usually that's posturing. Like Barack Obama did that when he was a senator once. And he really got dinged for that when he was president. And suddenly he had to deal with we might default in 2011. And he actually said, I took the wrong vote when I voted against doing that. That's just posturing. I don't understand why Republicans think they have so much to gain from doing this. They are trying to make the point that the reason we're in this pickle, the reason that we have so much federal debt and we have to keep borrowing more on top of more on top of more, is that the Democrats keep passing all these spending bills. But it's equally true that Republicans keep passing tax cuts that just add to the deficit, and they did that in 2017. That was at the time $1.5 trillion in new debt added to the national debt over a decade. I think the tally is now higher than that. So both parties do it, and they spend and cut taxes with abandon, and they don't care until these arbitrary deadlines come up and we have to raise the borrowing limit. I think we should just get rid of the borrowing limit. Congress could repeal this. This is not in the Constitution. Congress could just repeal it. That would be the sensible thing to do because this is imposing no fiscal discipline whatsoever.
Yeah.
The debt situation just keeps getting worse, even though we have this rule, in fact. But here we are at the circus yet again.
I agree. I have a feeling we're certainly not at the end of this. Could potentially kick the can down the road and could be talking about this again some months from now.
Yep.
All right. Rick Newman, thank you as usual.
See you.
All right.
Well, fears of an economic recession and debt default that Rick was just talking about have done little to scare retail investors, at least until now. Individual investors bought roughly $78 billion in equities and ETFs last quarter, a near record according to data out there. But are the jitters starting to creep in? Let's bring in Matt Porers, YouTube host. And Matt, we like to have you on. You've always got a good pulse of the retail mindset. What is the mindset right now with all of those headwinds we've talked about?
Definitely a fair amount of headwinds, but I think the major mindset right here, it might not seem that intuitive, but I would argue that this is a phenomenal learning opportunity. I truly believe it because a lot of the retail explosion came in 2021, so it was very specific to individual stocks. But now that the conversation is dominated by things such as the debt limit and what's going on with inflation, I actually think this has been a huge expanse in knowledge in the retail trading community.
Matt, Diane here. I want to ask you a question with regard to another topic that's kind of been top of mind today in the banking sector. We watched some of the executives on Capitol Hill today talking about the failures that led to SVB, Signature Bank. Is the retail investor paying attention to the regional banking sector?
More than you could possibly imagine. And they're watching it with a little bit of dismay and quite a bit of anger because we're seeing insiders try to defend themselves, even though we all know with SVB in particular, they were selling around $3.5 million worth of stock right before the bottom fell out. And it doesn't even really stop there at insiders to the company, but I would even say within the government. If you're looking at the time period of February, March, April, we had 18 different U.S. politicians trading just south of $7 million worth of financial-based stocks. And that's not even to get into the very well-timed tech plays that they got into right before they exploded. So yes, they are paying attention. It's becoming a lot more common to pay attention to what insiders and politicians are doing. And from the audience that I interact with on a daily basis, it's nothing but anger, and I would argue rightfully so.
Yeah, there may be anger, but there's also, we've learned from the past that retail investors see an opportunity. Is there an opportunity right now? I mean, we have heard the likes of Jamie Dimon say there's a lot of short sellers that are crowding the market that have led to the volatility within the regional banks. He thinks that, for example, there should be some consideration to banning short selling in the space. How do retail investors look at that?
I think there's two different camps on this. I would wholeheartedly argue that if there's manipulative shorting, yeah, that is not appropriate in any way. There's a reason we have these rules and regulations. But in terms of a fair and open market, if I kind of got my start in this community talking about AMC and GME and the retail movement behind those, I didn't see them trying to argue that they should stop the short selling then. So I don't quite see the difference here. Once again, I'm 100% against manipulative short selling. But in terms of just a functioning marketplace, I think it has its place without a doubt. And even historically, if we look back at it, 2008, I believe it was in mid-September, when there was previously a ban, there was a little bit of a relief. I believe it lasted literally for a singular day. And then from there, the bottom still fell out. So if we're just trying to stop the stocks from going down, I don't think that's really a solution here. I would actually take that a step further and argue that what's going on in the regional banking sector, it's not really a fundamental thing. I would argue it's not even a technical thing. I would argue it's more of crowd psychology. It's a horrific negative feedback loop. The stocks go down, people look at it and they figure, why take the risk of losing my money? So they go to the bank, take their money out. And then when we see an exodus in deposits, obviously there's legitimate reason then for the stock to go down more. And as you can see, it's just that negative feedback loop. So much more of a crowd psychology argument than whatever we're seeing in terms of fundamentals or even technicals.
There's a few things that stood out to me that you just said, Matt, talking about crowd psychology and the meme stocks, like say the AMC, the GME. Do the meme stocks matter anymore?
Yes, there's definitely a huge supporter group for it. albeit not as wild as it was in 21 when everyone was stuck inside getting their stimulus check and just paying attention to it. I would argue that the overall internet consumption, now that the world's fortunately opened back up, has gone down, but there are still a huge amount of loud supporters. But I would also argue that that group specifically is also more so becoming interested in the overall market and trying to understand how they can survive in this game, because obviously it's more of a marathon than it is an individual sprint.
Matt, we know you've got a lot to say on Robinhood. And Robinhood just announcing last week about talking about they now allowing 24-hour trading. But specifically, we should specify here, it is about the whole shares of 43 of the most traded ETFs in individual stocks. We're talking about stocks like Tesla as well as Amazon. We had a chance to speak with Vlad Tenev, the CEO and co-founder. Take a listen to what he had to say, and I'll get your thoughts on the other side.
Clearly, we think that this is going to lead to increased volumes, but perhaps the most important thing is just increased customer satisfaction. If you look at active trader net promoter score, that's up 30 points year over year. So our active traders are very, very happy, even in the face of kind of the challenging macro environment. Overall customer NPS is up 20 points year over year as well. And we believe if we keep innovating and keep our customers happy, no matter what the macro conditions, then it's all part of deepening our relationships with our customers even further. And 24-hour market is sort of certainly a component of that.
So 2 questions on the back of that, Matt. Number one, to what extent is Robinhood still the platform for individual investors to invest? And number 2, 24-hour trading, how much of that you think brings in new investors into the market?
Yeah, so for the first question there, at a certain point, I would respect Robinhood early on because they had phenomenal UI, they had phenomenal UX, they brought a lot of retail traders into the market, and regardless of the brokerage, I believe that Wall Street, the economy, investing in it is one of the best vehicles for wealth creation. I would implore anyone to gain a basic knowledge and as early as they can invest in something such as the S&P 500, and they meant that reasonable and much more reasonable for retail traders. Now, obviously, this story doesn't stop there. It took a couple of twists and turns, and that's where my love for Robinhood takes a very, very negative turn to the south. And yeah, they might be able to cite some of their year-over-year statistics, but if we look at that comparison, I think it's just because their customer satisfaction numbers a year ago were dismally bad. So is it the home for retail right now? Yes, obviously some people use it, but the popularity, I mean, you can see it in their earnings report, it's fallen off by quite a bit. Like they are nowhere near the height that they were in 2021. And now for your second question of this concept of 24-hour trading, I understand that a lot of people individually do what's best for you. If you have a proven methodology for whatever time frame, hey, if it's making you money, if you have a net expected positive value, go after it. But most people, especially in the short time frame, don't. The smaller the time frame, the more randomness involved. So what I see this is more of a ploy for them to get more active trading done on their platform, and then they're going to get the sweet, sweet deal of payment for order flow, which, without getting too far into the weeds here, I'm very, very much against.
Love this conversation, Matt Kors. Appreciate you coming on again with us so much today. Thank you.
Thank you.
Coming up, ready to find your next job on social media? Twitter has made its first acquisition in the Musk era. We'll tell you about it on the other side. Stay with us.
Well, Twitter is reportedly making its first acquisition under Elon Musk. The tech company purchased a job search startup called Lasky. Yahoo Finance senior tech reporter Dan Halley is here with the details. Dan, a recruiting startup, not what I envision to be the first purchase for Twitter, but we have heard Elon Musk talk about wanting a super app, wanting to turn Twitter into a super app. How does this fit into that ambition?
Yeah, it's certainly a strange acquisition on Twitter's part. It's part of the X kind of holding group that Elon Musk has here, which includes Twitter. And, there has been the conversation of him wanting to turn this into a so-called X app, a super app similar to WeChat in China. Doing that is going to be a little bit more difficult here in the US just because of how many different apps there are, how many different options people have. But a job kind of search tool that helps tech job seekers find positions really is a strange opportunity for Twitter to be taking. It just doesn't seem to line up with where the company is right now. They're trying to, they've been trying to cut down on expenses. That means trimming thousands of workers. That means cutting down on real estate. They've recently hired, obviously, or are going to put Linda Yaccarino in the place of CEO. She's coming from NBCU. And so, this seems to be a time where the company's really transitioning into something else. What that is, we still don't know yet. And how exactly this kind of job-seeking site lines up, it still remains to be seen. I think, overall, when you talk about an X app or an everything app, you think about payments, you think about communication, things along those lines. That's really where WeChat kind of shines, looking up different articles, things like that. Again, I'm not sure how this really fits into what Twitter needs, which is an influx of cash from advertisers who ditched the platform because Elon Musk took over.
Yeah, it does seem like a head scratcher, Dan. I mean, again, there's already LinkedIn, and so Twitter is not, where one usually goes to look for jobs. Or if people are going there, it's more of just in the social community aspect. I'm leaving this job. If you know of an opportunity, let me know. What do you see in terms of the response on social media about this?
I think it's confusion, right? And, just to go back to your point about LinkedIn, that's, become more of a social network. You're getting less of the, I guess, efficiency that you would normally think of when you think of LinkedIn. It's getting kind of spammy, or it's been spammy. It's becoming more of kind of the freewheeling social network that you see that kind of Facebook is. But you still, look, if you're thinking about jobs, you would think about LinkedIn more than Twitter at this point, especially just given Twitter's reputation. It, isn't really a place where many people like to spend their time outside of the, few hundred million dedicated users who are on there, namely celebrities, thought leaders, journalists, because they need to follow the breaking news that's happening, things along those lines. So, if I'm a job seeker, I'm not going to go to Twitter and start looking for my next job. I'm probably going to go to LinkedIn or something along those lines to get started. But who knows? If Elon Musk is able to turn this into an everything app, maybe this does become where people start to look. Maybe he'll start putting together a portfolio of companies that he can roll into Twitter or whatever he ends up calling it at the end of the day. And it really does become a super app. And that's, again, that's kind of the direction that this is heading towards. To start off with this app, though, it seems a little odd at this point.
Yeah, a long way to go to become a super app like WeChat, but certainly got a lot of people talking, at least for today. Dan Halley, thanks so much for that.
All right, Home Depot had a tough quarter. The company fell short of Q1 expectations and cut its profit outlook for the year. It seems consumer spending on home improvement is softening from the pandemic boom we saw. Yahoo Finance's Julie Hyman and Brad Smith sat down earlier with Michael Lasser, hardline, broadline, and food retail analyst at UBS to break down what Home Depot's lackluster results means for the state of the consumer. Let's listen to what he had to say.
After a period of outsized strength over the last few years, we are seeing that the consumer is shifting the spend to things like services, going out to eat, traveling, and that's having an impact on the consumption of goods. That's likely to continue for at least the near term. Now, the big wild card from here is whether or not the labor market remains stable. If the labor market declines from here, that's going to provide probably another leg of downside for the consumption of goods as consumers continue to pull back on their overall consumption trends. So it's something that is worth watching. But with that being said, right now the overall consumption of goods is seeing some weakness.
What does normalization mean for margin expectations for companies like Home Depot or Lowe's in that specific part of the retail environment?
So demand normalization for the home improvement retailers means that they are experiencing some margin pressure, and that's because sales are under pressure. What you would normally expect is that the deleverage associated with the fixed costs of this business on negative sales is going to create some margin pressure, and you're seeing that. There is a unique environment where inflation is moderating, and these companies have passed along significant cost increases over the last few years. So it's likely over time that will provide some margin relief. But for now, what's happening is margins are under pressure as sales decline.
Michael, got to ask you about lumber, right? Because that's one of the areas where we've seen lumber prices come down. And explain this to me, because I assume that that's a problem because Home Depot can't hold lumber prices up here if the underlying price is going down, because consumers won't, I guess they're aware that lumber's going down and they're not going to pay the same prices for it. Walk me through that.
Yeah, you're exactly right. Well, lumber is a commodity. So the prices change on a week-to-week basis, and the home improvement retailers pass along the changes almost on a real-time basis. So versus the same point a year ago, lumber right now is down about 64%. Now, normally what you would expect that when that happens, unit volumes will pick up. This is an elastic category, and if someone had put off building a new deck, as an example, because lumber had gotten so costly, that consumer might now think about restarting that project as lumber prices have come down. But what has happened this time around, lumber's fallen so fast that we have yet to see the unit response. That should happen over time. And from here, as we get into the second half of the year, the lumber prices will start to lap easier comparisons, and so the decline should moderate.
That said, though, isn't the margin on something like lumber consistent? In other words, does Home Depot, are they able to sort of peg it at the same gap on the way down, right? Their price versus what underlying lumber is?
That's right. Lumber tends to be a lower than average margin category. It's commodity, so it's very price competitive. And as a result, they tend to price to whatever the market's bearing at that time. So what actually happens is as lumber prices come down and this becomes a smaller portion of total sales, that's actually a good guy, because you have a smaller portion of your sales coming from a lower margin category. Now, over time, this tends to normalize, and it's not as much of a longer term consideration. But as you're rightfully pointing out, this can have some shorter term implications, and we're seeing that in the volatility as of late.
Michael, you began to touch on this a moment ago. Just kind of want to clarify, or perhaps ask you to add on to this a little bit more. Where would you say that we are at in the DIY cycle?
I think we're moving through the middle stages of the DIY cycle. As you are probably well aware, the consumer had binged on the consumption of a lot of goods over the last few years in areas like patio furniture, grills, appliances. And so some of that is being pulled forward, and there's evidence of that now. At some point, we'll get to a base level of demand, probably in the next few quarters, and those categories will start to grow again. And Home Depot and Lowe's should be prime beneficiaries as the cycle turns. But whether that cycle lasts another 2 quarters or 8 quarters, it's really going to depend on the overall state of the consumer environment. And at this point, that's going to depend on the labor market.
One more thing I wanted to mention about this quarter is what Home Depot talked about on the weather front, particularly in California, seeing some weather effects and the hit to sales. How broad is that impact going to be for other retailers that have exposure in those geographic areas too?
So we're going to see some of the same themes that Home Depot talked about on its call across the retail sector, not only because of the weather impacts, and we've seen that already from retailers like Tractor Supply and O'Reilly, but also just the overall environment for discretionary spending on goods has certainly taken a step down over the last few months. And we expect to hear that from other retailers over the course of the next few weeks. The question is whether or not this is a temporary condition because tax refunds are lower, the weather, SNAP benefits have been pulled back. And so do we start to see an improvement as we get into June and July? Or is this just the new norm? Consumer is fatigued on all the things that he and she have purchased over the last few years. And as a result, we're entering the later stages of the cycle, and it's best to have cautious expectations on the consumption of discretionary goods from here.
That was UBS analyst Michael Lazar speaking to our morning team. Well, coming up, we're going to recap the top stories of the day and get you set for what to watch on Wednesday. Stick around.
We got an inside look at the industrial economy here at Goldman Sachs' Industrial and Materials Conference. We heard from the biggest names in this space, including the CEOs of RXO, Clean Harbors, and Johnson Controls. Here are our 3 big takeaways from the event. First up, artificial intelligence, AI, the buzzword that's got Wall Street's attention. It's starting to transform the industrial sector, with more companies jumping on board.
We've been investing in AI for over a decade. And so if you think about the pricing algorithms that we've got that allow us to have best-in-class margins, it's because with every load that goes into the system, our algorithms get that much smarter on a pricing perspective for both the customer and the carriers. We're also using AI for customer integrations. What we see is that we're able to have our employees be able to do more per day.
A bull market awaits. It's almost like, what recession risk? The industrial economy is seeing signs of a recovery.
Today, we are in the start of a very significant, infrastructure build in the U.S. Some might call it a U.S. manufacturing renaissance. The level of spending that's occurring today is unprecedented. And so the tone coming out of the conference the last 2 days has been very bullish.
Worker shortage. Business leaders are having trouble hiring and retaining top talent.
We've had trouble. Our turnover, it's not just hiring people, it's retaining the people we have. And lowering our turnover rate down to pre-COVID levels, which has been terrific. So in my mind, I think it's as important to keep our own employees and provide a good career path for them as all it is to hire more capable bodies. It is improving, more holidays, better healthcare costs, providing a career path for our employees.
Just about every industry is abuzz about AI, specifically generative AI, but there are some alarming wild cards that come with it, especially when it comes to the entertainment industry. Yahoo Finance's Alexandra Canal is here to talk about what some experts are calling a Wild West scenario. Allie, what can you tell us?
Yeah, it's sort of this crazy moment right now when it comes to AI, especially in the entertainment industry. And there have been many recent examples. One in particular is a song that went viral on TikTok called Heart on My Sleeve. It features the AI-generated voices of Drake and The Weeknd, and it's led to a lot more questions when it comes to how these companies can really protect these artists and creators. Universal Music Group, which is the label that represents Drake, The Weeknd, Ariana Grande, a lot of really big names, they've spoken at length about the dangers of generative AI, especially if it's left unchecked. The company says it's currently in talks with lawmakers and governments to try and protect and defend creators' rights. But proponents of AI says that it's a very tricky thing because it's not like with this song and this example in particular, you are copying Drake's exact words or his song that he owns, but it's the voice. And there's no current precedent for that. On top of that is that general property belongs to the person who created it, and AI isn't a legal person. So it just adds to further complications here, and it's just an incredibly fast-moving space. We've heard from Spotify CEO Daniel Ek address this as well, and it's really trying to balance how do you leverage something like this to improve efficiencies and foster creativity while also protecting those artists.
Yeah, that specific issue we saw arise during the testimony over in Congress today with Sam Altman being asked about that. You're talking about the music industry specifically, but we've obviously seen the applications of artificial intelligence in other parts of the entertainment industry. What are some of the concerns there?
Well, you can look at the current writer's strike that's happening in Hollywood and really across the country right now as another prime example of this. The Writers Guild of America, they're demanding that restrictions be placed on the use of artificial intelligence in current and future projects. So they don't want artificial intelligence to be able to be trained on source material that real people, real writers created, so that that technology can then go out and spit multiple episodes or even a screenplay. It's kind of nuts to think that that's a possibility, but it is right now. And it's a conversation happening on both sides of the aisle. The AMPTP, which negotiates on behalf of the studios, they've admitted that ongoing conversations are needed. We heard from Disney CEO Bob Iger, who said overall he's bullish on the prospect, but that it is going to lead to challenges and complications in the future.
Yeah, certainly. And we just continue to have this broad conversation about generative AI, especially with OpenAI CEO on Capitol Hill today, talking about the standards that are needed to deal with things like this, you know? So it's certainly something we'll continue to watch. Thank you so much, Ali Canal.
Well, it is closing time here at Yahoo Finance. Let's get you caught up on some of the biggest stories of the day. Home Depot reporting a revenue miss in the first quarter and cutting its outlook over concerns about consumers pulling back on spending. The home improvement retailer blamed, in part, lumber deflation and unfavorable weather for the sales decline. Home Depot shares ended the day slightly lower, down about 2% there.
Meantime, the FTC is suing to block Amgen's $27.8 billion deal to buy Horizon Therapeutics. In its announcement, the agency says Amgen would be able to leverage its ability to, quote, pressure insurance companies and pharmacy benefit managers into favoring Horizon's two monopoly products, end quote. Both companies issued statements where they disagreed with the FTC and reiterated their commitment to completing the deal.
And finally, Comcast CEO Brian Roberts says it's more likely than not his company will sell its stake in Hulu to Disney. Due to an agreement between the two companies, Comcast could require Disney to buy out its Hulu stake as early as January of next year. But on the Disney earnings call, CEO Bob Iger said it's not really been fully determined what will happen with the stake when that deadline arrives.
And that will do it for today's Yahoo Finance Live. But be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.